Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in.
Happy Monday, everybody. I hope you had a restful weekend, and I wish you all a productive week ahead. It's the beginning of the week, so as usual, we begin with the economy. As regular viewers know, Beijing is currently hosting its flagship international business conference, the China Development Forum. The conference comes as China's trading partners confront oversupply risks in major industries, including electric vehicles and steel, which could spur manufacturers to dump excess goods on global markets. It comes too with, of course, increased geopolitical concerns and mixed views on the outlook for the Chinese economy. With dozens of top executives and industry leaders attending, there have been several notable statements made at the event. Yesterday, Sunday, IMF Managing Director Kristalina Georgieva expressed that China's economy is at a fork in the road where it must choose between past policies or pro-market reforms to unlock growth. She said the global economy showed remarkable resilience to shocks, but was headed for growth that was weak by historical standards in the medium term, as low productivity growth and high debt levels could progress. Commentators pointed out that her use of the term high-quality growth borrows from the rhetoric of Xi Jinping. It is also a concept we have discussed at length on previous China updates. How much of the 5% growth rate target will be made up of high-quality growth, and how much of unhealthy property and infrastructure spending. Georgieva said that with a, quote, comprehensive package of pro-market reforms, end quote, China could add 20% or $3.5 trillion to its economy over the next 15 years. She called on Beijing to strengthen China's pension system too, in a fiscally responsible way, arguing that this would help boost the spending power of individuals and families. China, of course, has chronically low levels of household spending. She also added, quote, investments in human capital, in education, lifelong training and reskilling, and quality healthcare will deliver higher labor productivity and higher incomes, end quote. Meanwhile, speaking at the same event, Premier Li Qiang downplayed investor concerns, saying his government is stepping up policy support to spur growth and systemic risks are being addressed. While Li acknowledged that many are concerned about risks in China's property sector and local government debt, he said, quote, some difficulties and problems are not as serious as people think, end quote. He also stressed China's focus on developing advanced manufacturing and technologies. People were more or less expecting Li to make these statements and these assurances, and they failed to impress markets. Of course, the elephant in the room, as we just touched on, is growing international criticism that Chinese industrial oversupply could lead to a crisis for world trade. The president of the European Union Chamber of Commerce in China has called for immediate talks between policymakers in China and the EU to avert trade tensions, expressing, quote, I think what we see right now is the unfolding of a slow-motion train accident. I think there's still a possibility of finding off-ramps, and that's what we hope. Overcapacity in Chinese industry is across the board, and I don't think we've seen the full impact yet. There needs to be an honest conversation between the EU and China on what is going to be done, end quote. Meanwhile, John Harrison, Managing Director of Emerging Market Strategy at TS Lombard, says that China's massive industrial policy, which is closely tied to its political economic system, will continue to generate trade tensions with the US no matter who is in the White House after the upcoming election, expressing in a report, quote, further escalation is inevitable simply because the US and also Europe will be unable to absorb the flood of manufactured exports from China, led by high-tech and green transition products, end quote. Meanwhile, while we're still on the economy, according to new data provided by the Ministry of Finance, the central government accelerated spending at the start of the year. Its general public expenditure jumped 14% from a year earlier to 482.8 billion yuan, $67 billion in January and February combined, the fastest pace for the period in 5 years. Regular viewers know that Beijing is gradually shifting the responsibility for supporting economic growth from local officials to the central government in the hope of diffusing local debt risks. Some analysts have criticized the approach as stealing from Peter to pay Paul, which doesn't deal with the underlying systemic issues. Others argue that it's a short-term fix, yes, but it gives policymakers much-needed time. Beijing is also trying to contain credit risks at local government financing vehicles. Xing Zhaopeng, senior China strategist at ANZ Banking Group Limited, said the latest data show Beijing intends to, quote, underpin growth while preventing risks. Its overall strategy would be to replace higher leveraging by local governments while still trying to maintain cash flow for local government financing vehicles. End quote. Meanwhile, US-based Bloomberg reports over the weekend that Beijing has kept the yuan in a, quote, vice-like grip, end quote, for 4 months. But now signs are emerging that they are ready to allow the currency to weaken. The onshore yuan on Friday slipped below the 7.20 per dollar line that had mostly held since November. Quote, the decline sent ripple effects across Asian markets, accelerating losses in some regional currencies and weighing on sentiment towards China-linked assets. End quote. The catalyst for the yuan slide, the outlet explains, was the People's Bank of China's decision to lower its reference rate for the managed currency by the most since early February. State banks also refrained from selling large amounts of dollars at the open. Quote, the People's Bank of China faces the difficult task of trying to stimulate China's fragile economy through monetary easing, while keeping the yuan relatively steady and preventing capital outflows. End quote. Next up, the UK-based The Financial Times, in an exclusive report published today, writes, citing 5 unnamed sources, that the US and Japan are planning the biggest upgrade to their security alliance since they signed a mutual defense treaty in 1960 in a move to counter China. Now, just quickly before we dive into this, if you're enjoying today's episode of China Update, it's a huge help. As always, if you can hit the like button, subscribe if you haven't subscribed for those who would like to see more of these sorts of episodes, and Patreon and Buy Me a Coffee links are in the description below for those who want to help keep the channel financially sustainable. I rely primarily on subscriber support to keep going, so this is a huge help too. Thank you so much, everybody, for the ongoing support. Let's continue. President Biden and Prime Minister Kishida will announce plans to restructure the U.S. military command in Japan to strengthen operational planning and exercises between the nations at the White House on the 10th of April, according to this exclusive Financial Times report. The outlet explains that the allies want to bolster their security ties to respond to what they view as a growing threat from China, which requires their militaries to cooperate and plan more seamlessly, particularly in a crisis such as a Taiwan conflict. As we've discussed in previous videos, Japan has, over the past couple of years, dramatically increased its security capabilities, spending much more on defense, including plans to buy US Tomahawk cruise missiles. The Japanese military is also setting up a Joint Operations Command next year to improve coordination between the branches of its own self-defense forces. We've also seen Japan growing closer to the Philippines, which itself is dealing with Chinese inroads in the South China Sea. Philip Davison, former US Indo-Pacific commander, expressed on the changes, quote, Japan's new national security policy is the most positive security development in East Asia in this century. The recognition that our two nations' defense strategies have converged makes improvement in our day-to-day command and control the logical next step. End quote. Christopher Johnstone, a former senior Pentagon and CIA official who now works for a Washington-based think tank, said upgrading the U.S. command would be a, quote, big step in building a more credible bilateral military alliance. Co-locating these commands, at least partially, would move the US-Japan alliance closer to the fight tonight mantra of the US alliance with South Korea, more responsive and credible in responding to regional threats. This would make a major contribution to deterrence in the region. End quote. This news comes days after the current US Indo-Pacific commander warned Congress that Beijing plans an invasion of Taiwan by 2027. Okay, that is today's episode of China Update. Thank you so much, everybody, for watching. Have a good Monday, have a good week, and I will see you all tomorrow.